Welcome everyone. How we doing? Hope everybody had a good day today. Welcome everybody. I'm just doing a few things. We'll get this here rolling soon enough. Welcome. A few more people rolling in. How's everybody doing? Everybody have a good day today, I hope. We had a little fun. Nothing too exciting. I love this. This was a nice boring day. It's been a while. Dude, epic. Goal achieved, Crashmas. That's all it did. That's the goal. $1 more than yesterday is that should be everybody's goal, in my opinion. So it sounds like you just crushed the day. Did good and bad. Yeah, nice. I took a stop out too. I took a couple. I think I stopped out twice today. Um, but it's nice little scalps too. That's always part of it, especially on a more rangy day. Obviously, great day for us to talk about trading ranges today. Um, uh, you're gonna get hit with maybe a couple more stop outs. You're probably gonna, well, if you're trading it as a range and not just preying on breakouts and breakdowns all day, you're probably gonna end up taking yourself a couple more trades than normal if you really want to capitalize on it. Or you hate trading ranges and you're here for that. And you're like, okay, how do I identify that we're in a range and I don't trade today? That's really, I think, going to be kind of a big part of this class. Because let's be real here, most people hate trading in ranges. They want the home run trend all days. But ignoring the last month, market gives us a lot of range movement, so it's worth it to learn how to trade it or learn how to avoid it. Kermit, how we doing? Aaron, welcome everybody. Happy to have y'all here. See, we got Burnt Peanut in here. That guy's always in here. Red, how we doing? Let's still give it a couple more minutes. Yep, exactly. This was a good one, in my opinion. I love trading this kind of stuff. I get how people could not, but uh, man, I was enjoying it. I'll tell you that much. Yeah, nice to see you here. You're putting in some work lately. Definitely noticing it. Good for you. Is that Aaron the plumber? Got me. Aaron, are you a plumber? Well, Fred, $1 million question. I mean, yeah. If like, yeah, I mean, if the plan that has been laid out in this 90 days passes and there you go, Aaron. Um uh I do wonder if that's who I think it is. Uh there you go. Um you know, if the tariff plan that was laid out there, with the massive ones ends up getting applied again, absolutely the market will dump. I mean, no questions asked. But that's 90 days away. We'll cross that bridge when we get there. I know we've heard uh all kinds of, first the tariffs were, official and no negotiations allowed and permanent. And then it turned into actually they weren't permanent, no negotiations are allowed. Then we kicked the can. Then we actually took away all of the big tariffs, left the 10% tariffs. Um, and said we had like 70 people trying to negotiate. Then it came out that like seven had actually tried to talk about it. And then we were told or 50 had tried to negotiate. Then we found out it was seven, and then 70 had tried to negotiate, and now they bumped it up and they say, or now down, up, however you look at it. Now they're saying 15 countries, I believe, have attempted negotiations. Completely unsuccessfully so far though. So we're back in that holding pattern. As most people know, what I was saying, no bottom without answers. I think the answers that we got have that's why we have set that bottom, though they weren't official answers or anything. Um, uh, you know, we still got some answers. So I think that's why we aren't plummeting now. That we would rather be we would rather be negotiating than have those tariffs. Nobody thinks those tariffs are a good idea. So um, now we're just kind of back in limbo for now. Welcome everybody. Give me 1 second. Got to make one more post. Yeah, they're getting you. They're getting you on your team, huh? Yeah, that 533, 532. That's a big zone. We were trading that. Yeah, sometime last week. Fridays, yeah, a few times last week. That's been a big one. You know, nice little spot for them to slow us down in the after hours. You gotta love it when it works like that. Okay, let me make one more post real quick. Like I said, sorry, give me a second. Flopping at a DM. Oops. And so 240 Tesla puts. I don't know, is Tesla dropping in after hours and everything else? Ooh, not as much as you'd like. Oh yeah, they're holding it up. 240 is a ways, but if this thing wants to move down, you should see a couple bucks in open. I mean, depending when you bought them. Unless you bought them like early in the day and got blown out, then you're gonna need some downside move just to see break even. Okay, welcome everybody. Happy to have you here, Dirty River. Tonight we're doing a little bit of talking on range trading. Like I said, a little bit when we were starting earlier. Like I said, people hate trading ranges. I get it. If you don't know how to trade them, if you don't like them, that's fine. This class can do two really good things for you. It can either teach you how to trade in those ranges effectively, or it can hopefully, and I might have not worded this the best when I was making the post about it. Hopefully, it will help you identify the range early. So if you are, and it's not going to be first candle of the day, but I'll get you early. So if you are a person that hates trading in ranges, then it will help you identify it early and you can say, okay, I don't want to trade today. But so with that, we're going to get rolling. Like I said, Dirty River, happy to have you here, and talk about a little bit of range trading. I'll try to keep my eyes on the chat to see if there's any questions. We're going to, like always, I try to do examples on the charts, things that we can identify on the charts, trades that maybe we can take on the charts. But before we talk about charts tonight, we're actually going to talk about kind of the trading psychology of ranges. Because as I was mentioning earlier, a lot of people don't like them. They'd rather trade breakouts. They want to catch those big volatile moves. They want, trends all day, just hold trades all day. Unfortunately, the market just doesn't give us that all that often. And so learning how to trade within a range is a pretty big deal. The market spends, I believe it's 60% of the intraday movement in ranges. You can feel free to double check that statistic, but ballpark 60% of its time is spent in ranges. There can of course be trends within ranges, but we as traders, if we really want to be day traders, need to cope with ranges. Like I said, whether it's you learn how to trade them or you learn how to not trade on the days that they are developing, you should be aware of them. You should at least know when to put that risk on, when not to put that risk on. However, there's something with range trading that people, I think one of the biggest struggles that everybody has is they're looking for breakout style movement. And so what I recommend in, range trading, actually size down, reduce those profit targets, and scalp. Scalping will be your absolute best friend on a range trading day. Of course, when the range breaks and it develops into a trend, then the range is giving you the best possible entry for that breakout or breakdown. But we just need to know that when we're trading, when we have range trading activity occurring, we need to be realistic with our trades. We don't want to have, and I know that people, and you guys have heard me, for anybody that comes, comes to my classes, and has come all the time. You guys know that I teach how important it is to have realistic price targets. And this last month, as I've been mentioning a lot, is that people have developed bad habits. We've had days where the market's down $8, $2, 2 hours later, it's up $10. The people who bought calls way too early and got blown out, got saved, or the people that bought puts early are trying to, say that it's going to keep going down while the market's just ripping in their face. And so a lot of bad trades have been saved in recent markets, and it's developed very bad habits for at least a lot of the people that I've been talking to, voice chat, trade floor, all of that stuff. I mean, we had a guy just yesterday super upset that he kept buying puts at support and it kept not working. And then he kept buying calls at resistance and it kept not working. Well, yeah, you're buying puts at support and you've developed bad habits over the last month where you maybe, there's what I always talk about. There's a very, very fine line between trading momentum and chasing. And you want to make sure that you are trading momentum and not chasing as best you can. Unfortunately, in the market, I mean, if we just zoom out, in this market with moves like the moves that we've had, just giant $10, $20 moves, the chasers, I ain't going to deny it, have been absolutely rewarded. Well, as the market finds itself back into normalcy, the people shorting the bottoms of big red candles and the people longing the tops of big green candles are likely going to start, taking those losses again. We've already seen it even in the last, day or two. Obviously range trading today. Yesterday, little bit rangy. I won't deny it. We had some ranged movement, but you do need to acknowledge that this is $4 to $5 movement. This is a $10 plus move down, $8 move back up. If you can't figure this out and this is too range bound for you, you're not gonna love the real market, So we learn how to trade ranges and we size down and we look for scalps and we be extremely patient for entries and we take the profit when shown. And so with that, unless there's any questions before we even start, we'll get really rolling on what I look for on range trading. And the first thing that we're going to do today is talk about how to identify the ranges early. So obviously for me personally, you guys all know I'm a big price action trader. I like letting the charts tell me what the movement is. So on today, they made it relatively easy for us early. One little trick, I don't know if it's a trick, if that's the way to put it, but something that I like to tell people to do is pull up your hourly chart. And then you're going to go to the first candle of the day. I know some brokerages, for whatever reason, they have their candles set on the 30-minute. Their hourly candles are set on the 30-minute. On Thinkorswim, obviously it's on the hour, where the hour starts, the hourly candle starts. Makes sense to me. But you want to find, I like the first hourly candle on Thinkorswim because you get a half hour of pre-market data and you get that first half hour of intraday market data. So we're 30 minutes into the day when this candle is done printing. So a very, very easy way to do this is drag a box around it. So you can see what I did here. I'm just identifying the top of this wick, and then I'm coming down to the low of this candle. Sometimes it'll be a low, sometimes it'll be a body, sometimes it'll be a wick. And then we're just dragging that box out. Well, now at this point, any trade taken with inside of this gray box should be viewed as a range, and it should be treated as a range where we want to be looking to be short on the highs. We want to be looking to be long on the lows. Maybe we're trying to catch bounces or just little rejections, but use this to your advantage. You guys saw it's the first 30 minutes basically of market open. We can put this range on our chart, and as long as we're inside of it, you really should be looking for range trading activity. Once we break out, you can try to catch a move, of course, but when you have when a range has developed long enough, eventually you'll get a nice little move, but it can very quickly develop into another range. So we're going to talk a little bit about, the multiple ranges that can develop throughout the day. But one of the best things you can do is identify this, draw this on your charts. In the first 30 minutes of the day, you can say to yourself, okay, this is range trading activity. I want nothing to do with it. This is different than my opening range, obviously, which is an hour and a half into the day, 18 candles, This, technically speaking, we're a half hour into the day. And, is this statistic helpful or anything like that? We do know at this point, statistically, 50-50 chance higher low of day has been set within those first 7 candles of the day. There's 6-7 candles of the day. There's a 50-50 chance that the higher low of day has been set. So if we've had a nice high and we've set a nice low down here, then with our low down here, then we're good to go. We've like 50-50 isn't great, but it's at least telling us that there's a high probability that we have a little bit of range movement ahead of us. Of course, like I said, if we start breaking out, we can try to trade it. But now, how do you trade this? That is where everybody struggles. And so the simplest way to think about it is buy low, sell high. And so what do we mean by that? If we start pushing down to some of the lows, then we want to look to be long. We don't want to look to be short at the lows. Rarely, you obviously never want to look to be short at the lows, but we want to at least be looking for volatile places to catch bounces. That's what we're going to look for. So, of course, this is hindsight 50-50 or, hindsight trading. We get to go back. We get to pretend we're the best traders ever. Whatever, I didn't take any of these trades that we're about to talk about, just to put the disclaimer out there. But I always love to go back and look at a chart, especially a range trading chart, where the very, very crucial thing for all things range trading is your entry. You guys know that when I teach anything, the most important parts of any trade are entry, number 1, stop out, number 2, take profit, number 3. Entry is the most important thing you can do. Knowing where you're going to stop out is the second most important thing that you can do. And then your take profit, who cares? It's more than that, but once you're green and you start pushing into EMAs, levels, VWAP, it's very easy to know where should I trim. And if you aren't trimming, that's a whole nother issue, but it's easy to know where you're going to trim. Well, a range and why they're so nice to trade in is because we have very, very defined entries and we have very, very defined stop outs. So for somebody like me that views those as the most important part of any trade, it's great because I am also lucky enough that I'm very, very willing to sit and wait for the trades to come to me. And in a range, that's what you have to do. So we're just going to look at today. We've identified our range, we're all set, we've identified our range. We've got our highs and lows on there. We're perfectly happy with it. Here's our 6 o'clock candle, and then there's our 7 o'clock for the highs. So, this candle just by chance lining up with these lows over here later in the day. But we have our nice range identified. We're only 30 minutes into the day. We know that we want to be dip buyers down here anywhere at the lows. Well, we still need to have our charts in front of us and be able to, we can't just say, oh, I am waiting for the bottom tick of the range. Maybe you take an entry, maybe you're like the luckiest person ever and you snipe it, I didn't, maybe you are, but I didn't. So we have to look at this. Our range is developed, but we also got a big important daily level right here, and we have our big important hourly 20 right here. That is Kermit, so I knew I shouldn't have said that how I said it. When I was hating on profit targets. But yes, when you're in a range, you look to take your money. Your money shows up, you take it. We know we have range trading activity. So we need to identify a couple places where we have interest in trading. So we know we have a range. We know we want to be long towards the lows of the range. And we'll get into some statistics as we talk a little bit more. So maybe you catch this entry and you're awesome. Maybe not. Well, this starts looking like a better entry. This 539, our 539.40 level, hourly 20 right here. We already know, okay, our entry is here. Our stop out is a close below here. So 40 cents of risk. We know that half of a delta, just under half of a delta, is what we're going to lose if this trade goes against us. This starts to look like a very, this yellow stair-steppy one right here, that's the hourly 20. And then this is the normal 20, the orange one up here. So this starts to look like a pretty reasonable entry. I know it's weird to think about because we're under the EMAs, we're under VWAP, blah, 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 but we're still in a range. So we are long at the lows. The only other thing that we can identify, and this is just today, this isn't going to be every day, we have a high here. We obviously have a news candle, so I personally ignore that one. And then we have our next big sell-off candle, again, kind of a news candle, but we have a nice little trend here. That's it, And so here's our range, here's our entry. We have, and this is developed, here's our high, here's our major lower high. I mean, you could even do it off of here. You can even go this candle to this candle. It probably looks like ridiculous off of those ones, but we know this might kind of be, and this is when we're down here, we have our trend drawn. We know this might kind of be our highs. So we know down here at our lows, we got about 40 cents of risk. Absolute best case scenario, we got about $2 of upside. So when we're taking a trade here, we kind of have a feeling bottom of consolidation, range day, a lot of wicks, bodies all over the place. Range day, we want to be dip buyers here. And where do we want to trim? I mean, 50 EMA, it's right there, but I'll tell you what, I'm probably trimming. You catch that instant 30-cent bounce, trim your 10, 15%. It's a range day. You launch to the 20, trim. You launch to the 30, trim. As you start getting up anywhere near these highs, I'm exiting. This is where you want to be out of the trade. And we can ignore the prices over here. We don't need to talk about the actual dollar moves. We need to talk about the chart. The chart tells us that we likely want to be out of any trades because of this consolidation. We also have the trend that so happens to be lining up over there. So we're dip buyers down here. And what do we do up here? I know it's not the top of the range, but we let the chart tell us what to do. We know we have consolidation over here. We know we've rejected here. We know we have a trend. We start getting up to trends. We start getting up to resistance. There's a very obvious answer of what we do here. We short the market. You want to be short on the market at the highs of ranges. And what do we do again? We target our lows. Is it always going to move down and hit your level perfectly? Nope. Is sometimes it's going to knife under it? Absolutely. No questions asked, but we let the chart tell us what to do. So in range movement that we've identified early in the day, we know, and I'm making, so don't quote me on this, but we know when we're in about the bottom 20% of that range, we want to be dip buyers. When we know we're in the top 20% of this range, and again, I'm just making up those 20%, it's different every day, always changing. If we're in those top 20%, we want to be shorting the rip up here. You of course don't just want to blindly do it. You want to look at the rest of the market, but we're analyzing a nice range chart here. So again, we look to be short here. And we look to exit most of our position down here. If you aren't trying to be short, but maybe you have a dip buyer mindset on the day for whatever reason, not saying it's right or wrong, we start to get back down to these levels. You start to view these as double bottoms, triple bottoms, whatever it is, with your same trade plans. We're dip buyers down here around 539.40, and we're stopping out below the hourly 20, 539. Can it go all the way to the bottom of the range and bounce? Yes, but we want to use the range to dramatically reduce our risk. Then again, we bounce up to the same spot. Don't be the person chasing calls. I'm happy with today because of this trend line. I talked about this one in the mastermind voice chat. I said, for anybody who's in there, I said, hey, we're breaking the trend on SPY, but they aren't winning. So you can actually let, you don't want to be buying the dips on this trend break just yet, you can buy one later in the day, but you don't want to be buying the dips on this trend break just yet. And so we look to be short again. I'm going to get rid of the trend line so we can just continue to look at the range, but we look to be short again. And if we shorted this once and we're taking this one, our stop is even more defined for us. Buying over these previous highs, we know that's kind of a break of our little micro range, and we might go test that 543. So we want to reduce our risk. Get in there 541.65, stop out 541.12. You got about 50 cents of risk. Best case scenario, $2.40 down to here is what you're looking for. So minimal risk, maximum reward. This is how we have to view all range days. Well, this is a good one because it starts bringing us back down. We break it. We even sell to the bottom of the range. You can see where we start to find a little bit of, trickiness going on. And so a range will always develop into a trend, and a trend will always develop into a range. So what I did today, and actually a trade, I don't remember, I mentioned it on Trade Floor. We had this nice little setup. Yeah, I think I did something like this. We had this nice little setup. Selling, selling, selling. We broke the bottom of the range. But this is where, as I mentioned earlier, we want to talk about, I want to talk a little bit about statistics. We broke the bottom of the range. Well, 80% of breakouts and breakdowns fail. That's not a statistic I made up. That's other people, they went back through 80 years of market data, realized that about 80% of breakouts or breakdowns fail. That's why, I might short it once, twice, three times. We started to get to fourth time, fifth time, sixth time. I'm not feeling as good because if we're really testing it, we might break. Well, we break down, instantly get bought back up. Break down again, instantly bought back up. Break down again, instantly bought back up, and are able to reclaim the trend. Well, at this point, we had a little downtrend going, but you might notice what we developed when we were doing this. So we took our little breakdown, we took our little lows to highs, and we have developed ourselves a new range on the day. Did we have a little hour of trending movement? Absolutely. But now we have developed ourselves another second range on the day. So, we can identify this from this candle down to, really these bounces here. I would start to say, okay, that's within, we started trending. Now we can start to say, here we are, we're in the range. So what do we do in the range? When we're up here at the highs, maybe we have this trend line, maybe we don't, but when we're up here at the highs, 539s, we short it. We, take these bounces up to it, you short it. Targets, bottom of the range. This is where you buy again, bottom of the range. Why do we buy the bottom of the range? Because our stop is tight. We're risking 30, 40, 50 cents, looking for $1.50 up, something like that. Not a huge move. It's a range. We have to live in reality when we're ranging. And so you buy the dips, you short the rips. You buy the dips, you short the rips. You buy the dips, And then I'll be honest, this one you might notice. So here's my daily level. We've broken below it. I count this as 1, 2, 3, 4, 5, basically 6 tests, 7 tests, 8 tests. I bought this little dip right here, looking for that move up. Not a big move, not a breakout, not a reversal, a move up to the high of the range, a move up to here. Why did I buy it? Back above the hourly 20. I had enough reasons to try to get in there. What happened to me on the next candle? I got stopped out. It's fine. That's no big deal whatsoever. Then, and this was in voice chat, then we sell back down. What do you think we did down here? We bought the dip on this one, and that one actually ripped for us. That one ended up being a really good trade. We bought one more dip here. Didn't rip for us, but in the after hours, eventually ended up, I think, giving about $3-4 a contract. Nothing too big, But this is range trading. So when we're at the lows, we're buying. When we're at the highs, I should have been shorting. I was saying, hey, we might break and bounce. Break and actually bounce out of this range. I wasn't expecting high a day. I was expecting to move to kind of the upper range VWAP sort of deal. That was it. But this is how I analyze any and all range days. You have to keep it super simple. You have to keep all of your mindset, realistic, small moves. You're going to take a lot of trades. Of course, I should point out, these are still couple few dollar moves on SPY. Pays very, very well. Normal range day where we're looking for maybe our buck 25 moves. You're looking at a bunch of nice 30, 40, 20 to 40% trades, we'll say. You're going to be happy when you take 3 or 4 of those and you've total made 100% on throughout the 3 trades. However, the person who holds all day looking for the breakout, very, very upset. But I want to point out one more thing. So this was our range. We shorted our range, and you might, so I didn't. Again, I just want to clarify, I did not. But we're short up here because we're at the top of our range. We got to pretend we are. You heard me mention earlier, one of the greatest advantages to range trading when a breakout or breakdown does finally show up. So again, we can look this way, say we short it. If you want to know what the chart's going to do to the right, always look to the left. Well, this is basically an attempted breakdown, an attempted breakdown, attempted breakdown, attempted breakdown. You can see we've tried this zone, 1, 2, 3, 4, 5, 6 times. Exact opposite of what I did here. This is where you can start to say, hey, maybe we're going to break it this time. We know 80% of them fail. Well, we've tried it 6 times, maybe the 7th is the time. Maybe the 8th is the time, It's very common to see 3 or 4 tests on the 5th try it breaks, which lines up real nice with our 80% of breakdowns fail when you get that move on the 5th attempt. Well, if you short up here, you have the best available entry for shorts for the breakdown. So now anybody else that is sat and waited for the breakdown catches the breakdown retest. Don't get me wrong, nice little $2 move down to the lows. Well, you have already caught a $3 move down while people are getting ready to chase the breakdown to the downside. So they get a nice little move down, no denying it. You get a $5 move down because your entry was the best. And so don't get me wrong, when I'm personally trading and when I'm, when we have very obviously range bound activity, when we get down to these lows, I'm jumping out of the trade. However, it is the type of trade where you can say, you've trimmed a bunch, you're in deep profits here. Maybe set your profits above your EMAs on a couple of runners, see if the breakdown wants to come. Worst thing that happens, we bounce off the bottom of the range and you get stopped in profit. Best thing that happens is you get to catch a little bit more sell-off, So a range will give you the best entry for, the counter trend trade, because technically we're going up here. So we take the counter trend trade on the shorts that turns into the breakout. Something that you always have to remember, without a range, some, consolidation, without some form of consolidation, you cannot and will not have breakouts and breakdowns, because consolidations lead to trends, which lead back to consolidations as the market digests. So that's what we see: consolidation, breakdown, trend, into more consolidation as the market digests. It will always work like that in the market. And so it is hilarious when we look at these recent days that we've had where, you know, is this a range? Yes, because it didn't close above its highs or its lows, and it spent most of its time trading within the same range, but it's a $20 range. So that's, that's reaching. This is real range trading. Couple of bucks. This is the type of thing that you will see in the market all the time. It happens to individual names, happens to your SPYs, happens to your QQQs, of course, and is amazing for us as traders because, don't get me wrong, if you short 542.62, you catch the whole $5 move down, and you hold this whole time, you're gonna make nice money. Don't get me wrong, you're in some 541s or 540s or whatever, you're likely going to be up a nice little 150% more, maybe, in a normal market a lot more, but a little 150 200% on that. Well, if you're scalping this range, here's a 30 to 50% move. Here's a 30 to 50% move back down, 30 to 50% move up, 30 to 50% move down. See what I'm doing here? Short and highs, buy and lows. Of course, maybe you get stopped out on this one, but entry, 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 all paying you more. You scalp this range, you will make more than the person that holds all day. And the person who holds all day celebrates, and then they cry, and then they celebrate again, and then they cry, and then finally they celebrate, and they get to make a nice little they get to finally take their nice profits down here at our big level. But the scalpers made more money, made it faster, didn't have to sit in a trade for 4 hours and hope that it goes their direction. Scalping will almost always provide you the greatest risk reward, or scalping in ranges will provide you some of the greatest risk reward in the market. It's very, very easy to find one risk, 2, 3 reward trades when we're in a nice tight trading range. When we're in a trending day, you're always going to have more risk in trending days because you're buying pullbacks. And the issue, it's not an issue. It's fine. Everybody should do it. I do it. But when you buy a pullback, you know that your stop is under where that trend started. So your stop is inherently wider on trending trades. For whatever reason, people are fine with that risk. But the reason that I love ranges is, are you going to catch every one of these bounces? Absolutely not. But you can catch quite a few of them, and they're fun. They're an easy trade. Very oftentimes they're 2 or 3 candles long. You basically get to trim 3 candles in a row and book a little bit of profit, and you're happy, and then you can start looking for a new trade. I, of course, know that this can be a double-edged sword and can lead to some serious over trading, which you will shoot yourself in the foot if you really are trying to catch every single one of these. The most important thing is just buying those lows, sell those highs, and then whether you're shorting the highs or not doesn't matter. Look for the move back to the lows to buy them again. Or on the other side, if you are shorting and you short the highs, sell at the lows. Look for the actual move back to the highs and try to short them again on your tight stops. Al Brooks has a phrase that he says, the market has a truly unbelievable way of printing candles that make you think one thing is going to happen, and then it does the exact opposite. So right here, I heard everybody this morning, bull flag, bull flag, bull flag. I was viewing these big wicks as not a good thing and not the place to be long, big level, but bull flag, bull flag, bull flag, crater the market. Now up, we are done for. Everybody, all puts, pile into puts, pile into puts. So they chase the candle, try to call it momentum trading, chase the candle and get blown out. When we identify our range early, we know that the last place that we want to be short is down here because that's almost the bottom of the range. So we don't want to be short there. If it gives us the breakdown retest, then awesome, but not the place where we want to be short. So Does everybody get that? That's intraday. We're gonna go to longer time frame stuff. The major things to grab out of this, you know, if I had to just give you 2 bullet points from what we've said so far, go to your hourly chart after the market's been open and we've had an hourly candle close. Grab yourself your little box tool, slap your box around this thing, around your first candle. Here's your range. Maybe it breaks, maybe it doesn't break. You never know. You never know what the market is going to provide you. You know, let's look at another day. And discuss it. You know, this one obviously leads to a breakdown. But let's discuss it. So yesterday, everybody tried to call it a range day. It's too much movement for me to consider it a range day. However, here you go. Here's our first hourly candle of the day. What do we do at the highs? We short them. What do we do at these lows down here? We long them. Do you eventually get blown out if the breakdown comes? Absolutely. Don't get me wrong. This is a little high to be buying, and this candle cratered. So maybe you avoided that buy right there, you know? But now we've broken outside of the range. So now we say, okay, we're below it. We can be short. We're going to target things like the opening range, hourly 20s. You know, we aren't just going to keep chasing the shorts down. And then when the market finally buys us back up, here we are back in the range, breaking back inside of it. I mean, if we zoom in, pretty obvious where the risk reward is here. You know, of course, don't get me wrong, market's already moved up $6, $5, you feel like you're chasing, but we've reclaimed all EMAs, we've reclaimed hourly 20, we've reclaimed VWAP, reclaimed everything we got right here, and got back in the range. And we're setting little wicks off of it. We know where our dip buy is, and we know where our stop out is. It's just a close outside of the range. So once we're back in it, fine. Small risk to get long here. Best case scenario, maybe you move to your daily level, maybe you get those, you know, the highs of the range, and you catch a massive move to the upside with very little risk, you know? And then of course you push up into this big level. I remember this, we traded this yesterday. All kinds of names were pushing up into resistance at the same time. You short it because you're near that upper part of the range. So does everybody get that? You know, draw your hourly candle, buy low, sell high. That's range trading in a nutshell. So on Thinkorswim, because an hourly candle starts on the hour, I'm basically, and I'm West Coast time, so give me a second. I'm basically drawing a box around the 9 a.m. to 10 a.m. East Coast time candle. And I don't do this a lot personally. I identify it I have other ways that I like to identify it. And I don't need the hour. I don't need to draw the box because I can kind of just glance at the screen and say, well, there's the high and low of the first hour. I like the opening range even a little bit more, but that one you're waiting until 10 o'clock East Coast time. This one or sorry, let me think about that. You're waiting until 11 o'clock East Coast time for the opening range to be set. This one, you have some amount of range set by 10 o'clock East Coast time. You're in there, you're trading, you're good to go. You've identified your range, and you know you can do it every day. You know, sometimes it's going to work great. You know, here's like news of the day. We'll just go through and look at how some of these work. See how often does the range provide trades, and then when we've broken the range, how often do we get provided a nice trade outside of it? And we'll just kind of cruise back through a couple of these days and see how it goes. And obviously massive moves in the market, but oops, one more second. And you can see this is my chart that I trade every day, so it's got all my trend lines. It's got everything that I've been looking at. So here we go. We've identified the ranges. You know, any of these could have been done within the first half hour of the day. Obviously, it worked beautiful for us today. Yesterday, definitely provided a trade to the downside, provided multiple bounces off of those lows, nice shorts at the highs, trade for the downside on the breakout, trade for the upside once we've reclaimed it. Couple of days ago, I don't know when this was, obviously set early in the day, had a little attempted breakout, but you can still attempt to be long here, looking for scalps up to the high of the range. Range breaks out to our level, pulls back to the top of our range, we view this as a breakout retest, and we look for some upside movement. Of course, can't expect that, but we look for some upside movement, all identified early. This one, probably got stopped out if you were trying to buy this super early one here. Maybe you catch the scalp to the upside. However, breakdown retest, beautiful. Range low also becomes the highs where, breakdown retest, these are still retests over here. Maybe you get stopped on the reclaim, but range tells us early where if we're long, we don't want to be long up into here, and we don't want to be short until we're outside of there. This one, who even cares? Doesn't even matter. That was just a rip of a lifetime day, so that one don't even matter. We don't care about that one. Oh, here we go. Nice little one. Obviously tried to reclaim outside of that range, had our strong level up here. Perfectly reasonable shorts. Yes, we are outside of the range. Unless I drew that one wrong. Yes, we are outside of the range, but look at all these wicks. You gotta be short here. Provides the trade down. Maybe you buy the dip here off of that previous low. Likely get stopped out. Don't really see breakdown retest. And God, now that I look, it's $3. So definitely provided a trade. No trades here. Don't really have a chance. Breakdown retest again, potentially. Who cares? Big move. Doesn't matter though. But trade the range. The range tells us when do we start looking for not ranged movement, and when do we want to trade that ranged movement. Here's a nice one. Range goes up, breaks out. As long as we aren't falling back into it, you can be a dip buyer. Even if we're coming up to the downside, if we are not buying back into it, you can trade the outside of it. In the range, we buy low, sell high. Outside of the range on the tops, we buy low, we sell high. Below it, we sell high, we buy low. So super simple. Aaron, is it smarter to expect a range and trade accordingly until the market breaks out of it? Absolutely. And this is a beautiful example of it. Of course, maybe you buy this dip low. It again provides the best entry for the long side if the breakout comes. You never want to expect some insanity like this. This was new, so I remember this day too. But buying low provides you the best potential entry for the breakout. Selling high provides you the best possible entry for the breakdown. Could you use the fibs to help identify them as well? Yeah, but I wouldn't. I would, I don't use fibs a lot. I know Fibs or Flips uses them, and I wonder if you're in Mastermind because he talks about them a lot in Mastermind. I trust my daily levels. I know where my daily levels came from. I like my daily levels. So I make use of my daily levels long before I will ever make use of a fib, But absolutely. One time where I will on occasion use fibs is if we're kind of I just can't think of a good example. I mean, if we're kind of in no man's land, we can just pretend. Let's see, I think this is my blank one. So we'll just pretend I don't have any levels right here. So if I didn't have any levels, maybe it's an all-time high breakout or something like that. These blue lines on my chart are the opening range. So I might do a little fib retrace like that if I have no levels. However, if you draw good levels or read price action well, you don't need fibs, like we can assume we're going to stop here because we stopped here earlier in the day. We can assume we're going to stop here because we've stopped here earlier in the day. So the fibs are great if you need them there visually. I won't ever tell you to not use them, but I can kind of just look at this chart and say, well, this is where we should stop, Kermit, your hourly levels aren't the same. That's because you're on like Webull, maybe even TradingView, something like that. Yep, you're in Mastermind. Yep. So Flips loves the fibs. He uses them intraday. He almost always pulls them on high to lows. Like I said, I use my daily levels, and if I don't have a daily level, I use the price action on the chart. So like I said, I'm always going to be looking for previous levels, anywhere where we've taken, bounces or rejections or anything like that. And so then again, if I was going to have places on this chart that I would personally take note of, I would probably, obviously here because of over here. Then on this downside stuff, I'm obviously going to be interested in here. This place, where we've reclaimed and bounced, anything like that, obviously going to be interested there. And then again, we're thinking when we're over here, I look at where all these wicks are developing, where do we have support? So then when we go to our fib retracements, very oftentimes you're going to line up with them. So, I mean, obviously, like this one's a little bit off. This one's dead on, close enough, the charts tell you what's going on. So that's why I personally don't use fibs. However, if they are helpful to you, slap those things on there. Just because I don't use them means nothing, I like my daily levels. I trust them more than anything. And then I use the price action on the chart, Like I said, I identify things on the left to see if it's going to happen again on the right. That's the best thing that I can do. Yeah, fibs are great for take profits as well. I like to use my EMAs, VWAPs levels. That's what I use. Obviously, hourly 20, that I only use, well, I use an hourly 20, I use the 20 EMA, I use the 50 EMA, and I use VWAP. Those are the only indicators that I use personally. Well, these blue lines are technically an indicator, I guess, but they're just charting the opening range for me every day, which I would do myself if I didn't have that indicator, So that's going to do it on intraday stuff. Real quick, I want to show you something on the daily because the daily charts can really help us. And this is one, let's see if I can find it again. Okay, so here we go. Look at my range is still here. So daily charts are amazing for identifying ranges that we can then trade intraday. I know this is hilarious that I'm going back to 2022, but this is something, these trades right here took up a month of my life trying to explain to people what they were doing wrong. So this is Caterpillar. Here's our range. This range was developed very early. We could have seen this pull up, bounce up, pull back, no questions. So we identify this on the daily chart. And then if we, we do the exact same thing we do on the short time frames. You do not long the highs. You short the highs. You long the lows. So for a month straight, we had people in OOT. Cat would get to 237. They would say the breakout is coming. They would buy calls and they would get smoked. Then a few days later, because they hold them, they never stop out. A few days later, they're saying, oh, we're good. Breakout is coming. I'm telling them, hey, you guys should short it and you should try to buy those lows at 226. I'm not taking any of these trades, but again, blown out. Bounce up there again. Here comes the breakout. Well, you can see it's just a range. You buy low, you make money. You sell high, you make money. You short high, you make money. Well, we start to look at our statistics. Here's an attempt, here's an attempt, here's an attempt, an attempt. Well, we've had 4 or 5 attempts. Now you don't short the highs, you likely buy the lows. So on these dips, you're buying these lows, providing yourself the best possible entry to actually catch the breakout. So I do this all the time. SPY, we can even talk about it right now. Today, we had some nice little range movement. Obviously, we set these highs. If we go to the daily chart, we'll go to my blank one again. We have these ridiculous candles. But we should probably look at this candle right here. It's giant. What do we want to do when we're up here at this high of this range? This, this 545, 546 up to about 548. Not be long. I'll tell you that much. There you go, Kermit. We want to short it. We want to lean short biased up here. I am in no way, shape, or form trying to tell you don't scalp calls. I was scalping calls today. You can scalp calls. You do not want to look for the breakout to come until that breakout comes. So we have to view this as the biggest range ever. I made a joke with my buddy 1K, said, I'm expecting a couple of inside days. Yeah, me too, because, an inside candle, that's what he means, an inside day. It falls all inside of a candle. Well, this candle stretches from 548 to 492. We can assume we're going to stay inside of there. If we get out, we can start looking for some upside moves. If we break down, we can look for some downside moves, but we shouldn't be overly bullish up here on SPY until we really start pushing over it. A bunch of people have been asking me, when do I actually flip bullish? Really over about 550, but That'll keep me bullish until about 554 once this little gap is filled. Then if we can get above that gap, maybe we can run up there and see those 560s. But for me, the closer we push to 550, the more I want to be short. Obviously this is a giant move, but we can see it on everything. Where are we starting? Where is the market starting to hold up? At these highs. We obviously haven't been able to sustain it. So we don't want to be piling in long tech up here, in my opinion. I had a guy in voice chat ask me today, swing Q calls. And I told him no, gave him a bunch of reasons, but one of the main reasons is no, we're way up here. You don't swing long way up here. He was also on Trade Floor saying, I said QQQ puts, but we'll ignore that. He for sure said QQQ. He asked about, 464, 5 swings or something. But check those dailies. I had somebody asking me today, I don't remember if it was pro or mastermind, but what do I do in the mornings to get prepared? I glance at the daily charts because I only trade daily levels. I glance at the daily charts and I form my bias. I'll happily change my bias if I'm wrong, but I glance at the daily charts and say, God, we're so high up here on the Qs and SPY that I'm really not looking to, be a dip buyer early in the day. And as we saw, we took that nice little push up. It's still ways above us, we took that push up and they started to smack us down pretty dang quick. I'm sure there was news or whatever, but we don't really want to be, and again, this is, I don't exactly know how to say this, so I'm going to say things that sound, kind of contradictory. We don't want to be like overly bullish up here. We can, of course, trade long up here. Look for intraday moves upside if the charts tell us it's going to go up. We can trade those upside moves. But we don't want to be getting long and swinging long up here. And the closer and closer and closer we get to the highs of this, that's when we start to say, we start pushing 547, 548. I'm not long, for sure. I am definitely not long as we push to these highs. Same as down here. We start pushing down here to these lows. I mean, it's 490. It's miles away. We could still be there. We've been doing fast things. I'm not short down here, 492, 493. Definitely not. So that is it. Daily timeframes covered there. Let's see, any questions? We got 5 more minutes. Even if it's not about this, talking about charts, anything, let's get them. Yep, Kermit, you were right there, short it. Yep, just scan the daily, I mean, I use because, I have my daily levels. I know where I want to trade. I know where I'm really interested in trading. Of course, I can take some scalps here and there, but I know where I'm interested in trading. I don't need to add any levels. So I just hop to the daily. I say, man, we're getting pretty up here. I probably don't want to be long. Do I note the date of my daily level and why I marked it? No, but I can find them. That's the key. Somebody was asking what was the level? What was the level? Was that yesterday? Oh, maybe that was Friday. It might have been talking about this 532, 533 buying that dip. I don't remember. But because I marked the major highs and lows, I can just go back here. I'm like, oh, well, hey, I see where these levels came from. It's easy. Oh, carry trade unwind. Yeah, you're a moron if you're short at the carry trade unwind, because my levels come from these major bounce points or, what was big rejection down, break above, consolidate, move up. There's my level. Then breakdown comes below it, breakout comes above it. I'm never going to label them on the side, but I can very quickly jump to the daily chart. Like if we're trading over here and I'm like, oh, why do I have this 569 level? Boom, I jump right back here, October. There it is, so I can find them quick enough that I don't date them. And then since I don't delete them unless they really don't work, I don't have to worry about it. Oh, Ramsey, I haven't checked that one out in a long time. I'm still holding one of those now that I think about it. Ooh, it probably ain't going good. I was trying to buy the breakout retest, so my share is red. Our earnings didn't go well. GameStop levels? Why is everybody talking about GameStop lately? Oh, because it's bouncing. I see here. Well, it's making it pretty obvious for us. We know where we don't want to be swinging long, and that's at 2756. big levels up here, big rejections up here. Had some wicks around and down, but 27.56, I sure ain't long. We break above that, and maybe you can go look for your 28.30s, 29.30s. But let's be real here. This morning, had I seen that, I would have definitely been short as we're pushing up. Oh, look at that funniness. GME still does funny things, huh? But definitely short biased at 27.50%. Can I run over the indicators I use again? Yeah, absolutely. Keep it nice and simple. Or I like to keep it nice and simple. So 20 EMA, orange line, 50 EMA, yellow line, pinky purpley line is VWAP. And then this stair-steppy one is actually just the 20 EMA, but from an hourly chart. So that's why it looks all stair-steppy. It prints here, and then this is an hour of time where the new one prints. So that's why it looks like a stair step, because it only gets new data every hour, and we're looking at it on the 5-minute chart. What online platform? I mean, Thinkorswim is amazing. And they'll pretty much give anybody free real-time data these days. Oh yeah, GME's trying to do that. Like, yeah, the Ponzi. Yeah, they're trying to hop on the Ponzi train. Yeah, I like that. Good for them. I mean, they need it. They need something to get them out of the dumps, I think. So good for them. Yeah, buy some Bitcoin. Yeah, thank you for being here, Roberto. That's awesome. Very nice of you. I'm hope everybody enjoyed it. Let's see. Cover the indicators. Yeah, no effectors. Yeah, get good at it or learn about it, or learn enough that you can avoid it. You don't want to be the person that goes on trade floor that's calling all of us like, assholes and saying we don't know how to trade and stuff because you got wrecked on a range day. So whether you trade them or don't trade them, uh, just identify. That's the most important part of this whole lecture. We can dive in. I love trading them. So if anybody likes it, we can always talk about it. No problems. But learn either how to trade them or learn how to run away from them. And if that works, then I hope this lecture works for you. Yep, Kath, everybody needs to practice it. That's what I think, is that really everybody needs to practice it as best as they can. And that's going to be the best thing they can do. Rob's, don't get sucked into that. Nah, yeah, don't get sucked into that, you guys. Don't get sucked into that. They have $1 billion in liabilities. If on their last earnings, as I recall, because I saw everybody saying that they got all this stuff going on, and then I looked, and they actually had 470 million in debt and $1 billion in liabilities. So be careful on what you read about GameStop. Yes, crash knows. Yeah, Jason, honestly, it is. It's how I trade every day. I think every day is a range day until it's not a range day. Uh, you know, every day is a range day until it's not. We start in a range no matter what. And so this is what I do all the time. I mostly wait for my daily levels to come into play unless I'm taking quick little volatile scalps. But you show me daily levels, a couple of EMAs, some VWAPs, and a nice range, I'm set. I love that kind of thing. You and your ASTS. But I understand if other people don't like it. So uh, you know, I love trading ranges. I understand how people could hate them. But man, this is awesome, dude. This is a really great turnout. Thank you everybody for being here. I see people disappearing. Sorry I didn't thank them before they left, but there's like 60 of us in here learning about trading ranges. That is absolutely epic. Thanks everybody for being here. Thanks for trying to learn more. Thanks for listening to me blab. Love it. Kermit, yes and no. I don't really ever plan on doing one because like there's this really since this class is over again, if anybody's got to get out of here, just fine. But so here's the issue. The days of gathering a lot from fundamentals are like kind of dead. I hate that this is being recorded and me saying it, but like you can't trade PE ratios anymore. You can't, like you can't trade the price to books. You can't, you can buy something. Yeah, thank you, everybody. Thank you, Clandestine. Thank you for being here, Kevin. No Fxers, thank you. You can find the occasional undervalued thing, things working on their debt. I'll show you one. AT&T. Here was, let's see, AT&T was one. They were building up massive debt to fix their infrastructure issues. Here's our alert. 1442. Did I get gap down on Mega? Yeah. We were trading at 30 years lows. The fundamentals did not support the price. They were trading basically at their book value. Did they have some debt? Yeah. But they said our main focus is going to be, fixing debt. Well, look at them now. I mean, they're up, over 100%. They finally did over 100%. Those are so rare these days. The fundamental analysis is tricky. Finding an undervalued company that's a reasonable buy is tough. The market does so much better these days on pricing things at either massively beyond what they're worth, your Teslas, things like that, or letting things trade down there low, it's really like if you want to trade fundamentals, you're going to be bored all the time because the like 2 to 3 times a year that some stock lines up with your fundamental trade analysis, you can finally put on a trade. But as far as, like studying them and trading exclusively on them, most people don't have the patience, the money, or the time to make it happen. The best things you can do, like Crash. I mean, like he keeps talking about this ASTS thing. It was, I mean, it was one of those ones that like it definitely like it caught some, as I recall, it caught some pumpy dumpy action. You can see it's not that I haven't looked at it. It caught some pumpy dumpy action without a doubt. It's absolutely mooned off the lows. Very unique company. They're actually doing pretty dang cool things. You know, it's the idea makes sense. How often will you find one of these? Almost never. That's the issue. So we can talk about fundamentals, but what I teach people these days is what you need to know about fundamentals is hit an earnings report, read the earnings report. Did they beat on the things that matter? Something, yeah, you probably have peaked on ASTS. I peaked on T at 14, so I'm right there with you, you read the earnings report, you see, did they beat their EPS? Is revenue going up? You learn enough about a company to say what matters to them. AT&T, I can use it again because it's one that I do trade and I do read their fundamentals. AT&T's main focus is reducing debt and subscriber numbers. If debt goes down, subscribers go up, AT&T is going up on earnings. It's that simple. If you start getting too hung up in the PE ratios and, all of that, you're likely going to miss a bunch of trades or you're going to buy things that it's not worth it to buy, I think it's, they're tough to find. They are out there, but because of that, it's really, really tough to ever like, hey, here's a lecture that you might use once, like that's the issue, at least for me. I am going to do a little bit nerdy of one in mastermind for people on basic fundamentals, but more focused on market fundamental stuff, understanding CPIs, PPIs, those kinds of things, and how we can potentially put some trades around them, saying is this good news bad news, or is this bad news good news, sort of thing. But it's not going to be diving into your PE ratios, your PB ratios, all of that stuff, because they're just kind of like, man, I've just seen things with such like, I mean, Shop had a PE ratio of like, I don't even remember. I swear it was like 1400 at one point, and the thing was still going up, So fundamental analysis is just tricky these days. Oh, we're chopping. uh, uh, those man, I gotta say those quantum computing ones are serious. Deep value investing. It is real. When you do it and you hunt it and you find one and you hit a winner, you can do it. I have one. This was a hit for me. Oh, dang it. We reverse split. I forgot. But this was one for me on iBio. I was in there 40 cents and ran her to $5, $6, something like that.
Why do I think Webull moved up so much? I've been meaning to look into it, but I gotta believe it has an extremely low float. And so yeah, yeah, because it has 11 million volume. That's why. Even 36 million volume, that's actually bigger than I would have expected. 3 million the first day. 36 million is bigger than I would have expected, but you have to think that is no volume, big picture. Because uh you know, it's I'm not calling it a pump and dump, but this is what pump and dumpers target. Something with a low float. When you're trading 11 million shares on the day, you go buy 1,000 shares, it's probably gonna move it. It's a low enough float that it will move. So when people buy, you get these gaps, you get constant halting, you get all of that. And it was just, subject to a low float. I mean, here's the greatest low float of all time. I mean, I don't know if you saw like this one. Um, oh, look, I even still have an alert on there. Oh, but they've reverse split now. Oh no, they haven't. Look at this. This thing released around like $5 and it ran to 2,500. This is real. This is no split prices, obviously. This is real. This actually happened. And it's because look it moved, it moved the range on the day. The low was $278. The high was $2,500. It did that on a million volume. I was trying to trade it. Buying shares was hard. There just wasn't many shares available. So when everybody keeps buying higher, price goes up. Yeah, I did miss out on a couple of those. Those ones actually put in some pretty nice moves. Yep, float is how many tradable shares. Yeah, and I like those quantum things. I mean, I don't get me wrong, you can tuck some of those in your back pocket, but maybe it works, maybe it doesn't. Gold is exploding. It's got that doing. Wow, not kidding. Okay, well, if that is going to do it, thank you, everybody. I appreciate that. This was an awesome lecture. I really appreciate all of you being here. Hopefully you learned something. And we will catch you all tomorrow. Thank you so much again. We'll talk to you soon. Yep, thank you.